We all know that good things come to those who wait, and today is the perfect example of that. Welcome to the launch of our 2 global equity funds, which are finally available on South African shores. Ferdy van Heerden will kick the session off, and after him, Glenn Owen will give us some insightful economic commentary. Thereafter, Natalie will be hosting 2 panel discussions with our global investment experts, who will be introducing the 2 new funds that we are launching today. As a reminder, please post any questions you may have in the Q&A section, and please do enjoy the session with us today.
Welcome to the South African launch of our 2 flagship global equity funds, and thank you for joining us today. Although I am based in London, my roots are firmly South African. With family and friends in SA, I was very pleased when SA was recently removed from the UK's red travel list, and I wasted no time to travel there earlier this month. More notably, I am and have always been excited about the future of South Africa. Of course, there are challenges, but this is no different to most parts of the world. It is important, though, to focus on the fantastic business opportunities and possibilities. Having said that, beyond the shores of South Africa lies a world of opportunities for investors. There are bigger, deeper capital markets in many countries across the globe who are at different stages of their development, with different currencies, with unique industries and companies to invest in and use for diversification. So why are we here today? We are excited to finally be bringing our 2 flagship global equity funds to South African investors, to give your clients access to global markets via these funds with a wide range of ideas and investment opportunities. These funds will bolster our existing long-established global multi-asset investment offering that we already have in place for our South African investors. But first, a bit about our heritage. For those of you who do not know Momentum Global Investment Management, or MGIM for short, the question is surely, what makes us different? If I have to summarize it, without a doubt, our partnership DNA. Having been established in London in 1998 as the international investment arm of Momentum Metropolitan, we have combined the benefits of our proudly South African heritage and culture with a global lens and access that London provides. We have built our business since its inception through partnerships with financial advisors and wealth managers around the world. And we did so by structuring and managing globally diversified solutions to help you and your clients navigate the global investment landscape. We work with advisors in South Africa, the United Kingdom, and also with many international IFAs based from as far as Japan to Southeast Asia, Hong Kong, the UAE, and Latin America. Many of these relationships have been around for a decade or more, and they continue to evolve as the world around us keeps changing. Given that we partner with advisors in multiple markets across the world, we can confidently say that our investment research and solutions, as well as our global client base, are truly global, giving us unique insights into international investment trends and developments, but also the needs of financial advisors. Since our origins almost 23 years ago, we have focused on building and managing multi-asset, risk-profiled, and tailored solutions for financial advisors across the world, underpinned by our specialist single asset class capabilities and solutions that provide core building blocks for these funds, but also for advisors, discretionary fund managers, and institutional clients. Our solutions are designed to deliver outcomes that advisors have told us their clients need to achieve their diverse financial goals. This is, of course, based on the Momentum Investments outcomes-based investment philosophy that strives to optimize the probability of delivering a target outcome over defined rolling investment periods and within specific risk parameters. The main purpose for us is to offer investment solutions that can achieve the investment targets with higher levels of confidence while smoothing the investment journey so that ultimately clients stay invested over time. Of course, to deliver these solutions, we need great people with strong technical capabilities and an engaged culture. Our team in the UK is well established, disciplined and collegiate, and with a strong can-do culture. The senior investment team has been together for more than 10 years. MGIM now consists of just over 60 people in the UK, working from 3 offices located in London, Liverpool and Windsor. We have a dedicated investment management team consisting of 21 investment professionals and an investment consulting team consisting of 11 consultants and analysts, supported by a strong operational and distribution services team. And while investment talent, resources and expertise are the cornerstones of any investment business, it is the ability to truly understand our clients' needs and the intent to work together with advisors to deliver appropriate and differentiated solutions that sets us apart. I truly believe that this is Momentum Investments and MGIM's competitive edge. With over $6.5 billion in assets under management in our funds today in the UK, and more than $50 billion of pension fund assets where we provide asset consulting services, we are a well-established business with the additional security of being a wholly owned subsidiary of Momentum Metropolitan in South Africa. So as a business, our size enables us to operate with nimbleness, with agility and flexibility of an international, may I say, boutique investment manager, but with the financial strength and governance focus of a large listed parent company. Whilst we have an organic growth culture, the recent acquisition of Seneca in the UK has had numerous benefits for our business. A stronger combined investment team with a very similar investment philosophy, a wider product offering that caters for a broader range of risk profiles, specifically in the UK market, and complementary investment expertise, specifically in alternative asset classes such as energy storage and digital infrastructure, which our South African multi-asset funds have already leveraged as a result. Importantly, from a South African perspective, Momentum Investments, including MGIM, is fully committed to advice-led investing. That means that we are focused to support and enable South African and our other international advisors with regards to their clients' global investment needs, to increase and optimize the offshore diversification within their portfolios. To do so, we have had a range of multi-asset funds for SA offshore investors, to which we will now be adding these 2 global equity funds. The multi-asset solutions offer a full range of risk profiles, of asset classes, investment strategies, currency exposures, investment styles, and are implemented through best-in-class, carefully selected global and regional managers, all designed to provide your clients with true global diversification. Our Momentum Global Cautious, Global Managed and Global Growth funds are all multi-asset funds, available offshore as dollar-denominated funds, domiciled in Guernsey, or onshore in ZAR-denominated feeder funds. But given the increasing need for advisors to have access to pure global equity exposure for many of their clients, both in South Africa and elsewhere in the world, we have decided to make our 2 Luxembourg domiciled UCITS global equity funds available to SA investors. These funds provide access to predominantly developed market equities in a style blended approach. Both these funds are actively managed with good TERs given their respective AUM sizes. They are designed as a core equity holding for investors, but can also be used as an addition to a broader client portfolio to add diversification benefits. The Momentum Global Equity Fund uses best-in-class global managers, while the Momentum Global Sustainable Equity Fund is invested using a systematic multi-factor approach with strong ESG credentials and implemented through the use of Rubico capabilities, who is a world-class quantitative and ESG specialist. So in summary, the two new global equity funds deliver in terms of cost, the increased focus and need to focus on sustainability, and also the use of stronger quantitative data sciences capabilities. Through the consistent application of our outcomes-based investment processes, all 5 of these funds have good long-term track records, generating attractive peer-relative returns on a risk-adjusted basis, and consistently having ranked in the first or second quartiles against all Morningstar peers over the last 5 years and since inception of the portfolios. Finally, we will continue to seek opportunities to strengthen and expand our global offering that will support our advisor partners with investment solutions that will enable your clients' financial success. And therefore, we are pleased that we have received Section 65 approval for the distribution of the 2 global equity funds in South Africa. And we firmly believe that these 2 well-established global equity solutions will be value-adding to your global investment toolkit. And as you know by now, for Momentum Investments, investing is personal. And we look forward to working with you and your clients on their international and global investment journey. Again, thank you so much for joining us today, and I really hope you find value in the upcoming sessions in this launch.
The COVID pandemic has dominated the narrative in global economics and financial markets for almost 2 years, to the exclusion of almost all else. While concerns remain, especially the possibility of increasingly transmissible new variants, the world is steadily moving out of the crisis and learning to live with the virus as it heads to endemic status, in large part due to the success of the vaccine program and rising levels of immunity, but also to the development of effective treatments. Very few countries now use widespread strict containment measures to control the virus. We're learning to live with it much as we do with other deadly viruses. Economic activity and mobility are returning to normal, albeit at a different pace across sectors and countries. And even if there are setbacks from here, we know that businesses can cope well and incomes remain strong, enabling consumers to bounce back rapidly. We can therefore focus on the secondary effects of COVID, which have become the dominant driver of markets in recent months. It's become clear that the peak pace of recovery from the pandemic-induced collapse in activity is behind us. But across most countries, both the manufacturing and services sectors remain buoyant. Purchasing managers' indices are reliable leading indicators of economic activity. And as the first chart here shows, PMIs for leading economies have slipped back from the peaks earlier this year, but in most cases remain well above the 50 line, the threshold between expansion and contraction. Although the boost from the release of pent-up demand as lockdowns eased will inevitably fade, and the fiscal impulse is falling as the crisis spending to cushion the effects of the pandemic drops off, earlier fears of a sustained increase in unemployment have not been fulfilled. Employment growth remains strong, and underlying demand is underpinning growth. But other factors are also at work and are clouding the picture. From the perspective of financial markets, surely the most extraordinary feature of the pandemic has been the simultaneous shock to both demand and supply, and the consequences as lockdowns and mobility restrictions were lifted. The collapse in demand last year was unprecedented in scale and speed, but proved to be short-lived. Incomes were largely protected by furlough schemes and handouts, and household wealth soared as house prices and stock markets recovered rapidly from the initial shock. The release of pent-up demand has given a boost to growth not seen in almost half a century, and most forecasts point to continuing high levels of growth next year, albeit below the exceptional rates of this year. The supply side, however, which suffered factory closures, lengthy periods of curtailed output, is now struggling to meet the unprecedented surge in demand. Supply chains are severely disrupted by labour shortages across many sectors and countries, by port and factory shutdowns and reduced working, exacerbated recently by China's critical energy shortage and enforced cuts in production. Energy prices and freight rates have soared, and sourcing materials and components has become difficult. Rebuilding supply and distribution chains is not an overnight exercise and is expected to continue to be a headwind well into 2022. Surging demand meeting restricted supply is resulting in sharply rising prices. And this combination of factors is now the most widely reported concern of company management and largely accounts for the warnings of reduced shorter-term expectations for revenue and earnings growth by many companies. Now, those higher prices are feeding through to consumers, especially in energy, which of course has an immediate impact on disposable income, acting in effect as a tax increase. Although wages are rising in sectors most exposed to labour shortages, in aggregate, wage inflation is falling short of price inflation. And in the face of rising uncertainty, consumer confidence has dipped recently. The most visible impact of this exceptional period of supply-demand imbalance has been surging commodity prices, exaggerated by the base effects from last year's collapse in prices, and in input prices, shown in the next chart. Producer prices in the US are rising at close to double-digit rates, and even higher elsewhere. The euro area, for example, the PPI is running at 16% over the past 12 months. And some of this is inevitably feeding through to consumer prices, with core inflation measures in the US rising to 30-year highs. Inflation has become the primary concern of investors. Will it be transitory, as the Fed and other central banks believe, or will it be persistent, which could trigger a sharp reaction from the Fed or a bond market rout? The outcome of this question will be a key determinant of monetary policy, the durability of the recovery, and as well as the broad direction of markets, the relative performance of asset classes, sectors, and investment styles. For now, the market buys into the central bank narrative that the rise in inflation will be transitory. But there's no doubt that the disruption to supply chains has been more damaging and inflation more persistent than central banks and indeed many others anticipated. Keenly watched forward inflation expectations in the US and elsewhere have moved up in recent weeks, especially for the more immediate periods ahead. But as can be seen from the chart, longer-term expectations in the US are still broadly within that 2 to 2.5% area that prevailed for much of the past decade or longer. The five-year inflation line on the chart shows annual inflation 5 years from now over the subsequent 5 years. It's a measure of future inflation which is widely watched by the Fed and many others as an indicator of longer-term inflation expectations, and it smooths out the effects of sudden price shocks which have largely short-term implications. Now you can see the five-year rate has moved up from the pandemic lows when it reached about 1.3%, but at its current 2.2%, it's ringing no alarm bells. Wage inflation, a key determinant of the persistence of inflation, has also moved up. The widely respected Atlanta Fed wage tracker shows wages rising at a 4.2% rate in the US, the highest since 2007, but well within the range of the decade pre the global financial crisis, and again, not causing concerns among policymakers. Outside the US, policymakers in the euro area and Japan are still more concerned about longer-term deflation than inflation, while in the UK, where inflation is broadly matching that in the US, the central bank remains firmly in the transitory camp of inflationary expectations. So we're at the stage of this cycle then when the global economy, while still strong, is losing some momentum, stretching from China to the US. The impact of the pandemic has faded, but continues to slow reopening efforts in some countries. Part shortages are hitting production, and power shortages and price spikes are dampening consumer sentiment. At the same time, demand is strong enough, especially in combination with supply constraints, to push up inflation and create heightened uncertainty about the persistence of those price rises. Markets have reflected the fears of slowing growth and higher inflation, with increased volatility in recent months and concerns about the return of stagflation, a backdrop not generally supportive for financial markets. Our proprietary risk aversion index in the next chart illustrates how risk in financial markets has picked up significantly in recent months. But to keep this in perspective, it remains far below the levels reached during the height of the pandemic. Today's concerns are not to be underestimated, but they're not systemic risks which would trigger a sudden, sustained fall in markets. The lingering effects of the pandemic and the unusual nature of the underlying causes giving rise to current uncertainties are giving central banks pause for thought as they plan the exit from their pandemic emergency policy measures. Policymakers are undoubtedly erring on the side of caution before removing stimulus. The road to normality will be long. The Fed, of course, the key central bank and custodian of the world's reserve currency, announced earlier this month its well-flagged intention to begin to reduce its huge asset purchase program, starting this month. But it will do so only gradually, and in the meantime will continue to hold interest rates at near zero levels, with the first interest rate rises not expected before the second half of 2022. The monetary policy cycle has turned, but the signals from the Fed, the European Central Bank, the Bank of Japan, and the Bank of England all indicate no preemptive tightening and a very accommodating policy for a long period ahead, running into years. By any measure, monetary policy remains highly supportive for economies and financial markets. Bond markets perhaps best illustrate this. Yes, yields have risen from the pandemic lows, but are still at levels which are remarkably low by any historical standard, and which reflect few concerns about rising inflation and tighter policy. As you can see from the next chart, yields on 10-year US Treasury bonds have risen over the past year, but at around 1.5% today, they're at the low end of the range of the past decade. While real yields, which take account of 10-year inflation expectations, are well into negative territory at minus 1.1%, close to the lowest levels in history. Now, these are very loose financial conditions and will remain so, even with the modest tightening now underway. The obvious danger is that policymakers are underestimating the persistence of inflation, and if they leave it too late, will be forced into more aggressive tightening than otherwise, an outcome which would risk a significant setback in markets. Our central case is that inflation will peak around the middle of next year and gradually thereafter move down towards central bank targets. The exceptional release of pent-up demand will be satisfied in due course, and supply chains will gradually return to normal. They will be rebuilt, while longer-term forces such as high level of government debt left by the pandemic, demographics, digital disruption, and productivity enhancing new technology will restrain price rises longer term. But we recognize that the risks of a longer period of persistently high inflation have risen. And we believe it's important to reflect that risk in portfolio construction, including in the composition of global equity assets. What lies ahead then is a progressively fading impact from the pandemic, growth at abnormally high levels this year, the fastest rate of expansion for 50 years, and continuing, albeit at a reducing rate, into next year, highly accommodative monetary policy, and fiscal policy continuing to support demand with no prospect of a return to fiscal austerity. Governments right around the world, led by the US, are planning for high levels of fiscal spending on infrastructure, health, climate change initiatives, and rebuilding post-COVID. There are significant headwinds from supply constraints and sharply rising inflation, but these should begin to diminish and normalize over the next 12 months as the global economy transitions to a reduced but more sustainable level of growth. The early months of recovery from the pandemic were probably the most rewarding for equity investors in this cycle, and the transition to lower growth with a gradual reduction in ultra-loose policy support at a time of resurgent inflation is more challenging for financial markets. Returns will be harder to come by, and inevitably there'll be setbacks from time to time, just as we saw in September. But this remains a constructive environment for risk assets and not the conditions for a sustained fall in markets. The cycle is likely to be long. The recovery from the pandemic has further to run. Financial conditions are supportive and corporate profits are generally buoyant. With the prospect of supply chains normalizing through next year and healthy underlying demand continuing, earnings and dividends across the corporate sector are set to build on this year's recovery and advance in real terms in coming years. We believe that equities will therefore continue to deliver attractive returns, albeit with a somewhat bumpier path. Underpinning our constructive view are valuations. The next slide shows forward price earnings ratios of leading equity markets. As earnings collapsed for many sectors in the pandemic, the aggregate price earnings ratio rose sharply, but over the past year has come back down equally sharply as earnings recovered. A trend which continued through the third quarter of this year, as recent earnings reports have shown. The recovery and subsequent growth in earnings has far outstripped share price rises, so bringing PEs down in most markets to levels in the mid to low teens, broadly in the range of the past 7 or 8 years. The notable exception is the US, the standout equity market performer of recent years, and which is a higher proportion than other markets in highly rated growth stocks. Outside those growth stocks, there remain plenty of reasonably valued opportunities, both in the US and elsewhere. In nearly all cases, equity valuations compare favorably with bond yields, as we see in the next slide. Those investors seeking income can no longer regard bonds as the defensive asset class providing a real rate of return. Increasingly, they're turning to equities for income, with the added advantage of protection from rising inflation, a characteristic which, of course, the vast majority of bonds with their fixed coupons simply cannot match. While we firmly believe it's essential to stay with equities through the cycle to generate long-term capital growth, we also recognise the heightened uncertainties around the way in which this cycle will evolve. There can be no certainty about the sectors, companies, and investment styles which will thrive best in coming years. For some years, investors have increasingly been drawn to growth stocks, big tech, the so-called FANGs, Facebook, Apple, Amazon, Netflix, Google, and the like, which have grown rapidly in an increasingly digital world. The trend was accelerated by the pandemic, as we can see from the next slide, which shows the performance of a range of investment styles since the beginning of 2020. As you can see, all styles fell sharply as the pandemic struck, although quality and growth proved to be more resilient. These two styles then soared ahead, with growth in particular proving to be the great beneficiary of lockdowns. In contrast, the styles more vulnerable to the collapse in economic activity, value, and small cap, fared badly. But look more carefully at the chart, and you can see that as news of the vaccine success was announced a year ago, value and small cap recovered very sharply, materially outpacing growth and quality. Between late October 2020 and mid-May of this year, value and small cap, being the biggest beneficiaries of economic recovery, delivered returns of around 40%, twice the return of quality and growth stocks over the same period. More recently, as concerns about the durability of the recovery have surfaced, value and small cap have been moving sideways, while growth and quality have moved ahead. It would be easy to follow the trend and concentrate equity investments on growth stocks, which will continue to benefit in the long term from the digital transformation underway globally. But in our view, that would be a mistake. Growth stocks have obvious long-term attractions and have a place in portfolios, but their outperformance over several years has left them on relatively high valuations. Furthermore, their extraordinary success during the pandemic and in recent years generally has brought forward growth, and it's given greater prominence to the reach and power of these companies, in turn strengthening the resolve of regulators to rein them in. Much as we've seen, incidentally, in China this year, although in this case, the tightening of regulations was abrupt and draconian, with objectives stretching from societal to the absolute preeminent control exercised by the Chinese Communist Party, with considerable damage, as we've seen, inflicted on those companies in the firing line. The importance and size of this growth sector, accounting in the case of the US for more than 25% of the stock market capitalization, means the risk of a regulatory clampdown has been worrying investors and is unlikely to dissipate. Growth stocks are also more vulnerable than others to a rise in interest rates. Their high valuations mean that any increase in the discount rate, any increase in interest rates used to value those earnings, will have a disproportionate impact on share prices. They're in effect long duration assets. Value stocks are much less exposed to a rise in interest rates, and their earnings are more economically sensitive, so are prime beneficiaries of strong economic growth, and financial stocks represented significantly among value stocks will be direct beneficiaries of tighter monetary policy and higher interest rates. The multi-year period of underperformance of value stocks has left them underowned and undervalued, trading at the widest discounts to growth stocks in decades. Amidst concerns about the durability of growth, quality stocks could prove to be a defensive component of equity portfolios. Their typically resilient earnings and strong balance sheets enhance their attractiveness in the face of current uncertainties. As my colleagues will discuss later, each of these three investment styles, growth, quality, and value, have outperformed broader market aggregates over the long term, but with considerable variability in each case. Our investment approach has always been to build equity portfolios using a blend of these styles, which has the merit of capturing the long-term outperformance, but at much reduced levels of volatility around broad market returns. We remain as true to that approach today as ever, blending styles to optimize returns over the long term. Indeed, there's an even more powerful case, we think, in current conditions to diversify by style, given the uncertainties and unprecedented nature of this cycle. The pandemic illustrated yet again the futility in trying to time style shifts. They're invariably very sudden and unpredictable, and inevitably missed by those who are not already positioned. Much better, in our view, to hold a portfolio of blended styles to capture these moves, rebalancing as and when valuations and relative price movements present opportunities. We will continue to hold growth stocks to participate in long-term structural trends, alongside value stocks that are geared into economic recovery and trading on these historically low valuations, and quality stocks exhibiting high profitability, strong balance sheets, and pricing power, resilient and defensive characteristics. Across all investment styles, we're firmly of the view that this is the stage of the cycle when careful selection will be vital. Blending styles in this way, actively managed by best-of-breed managers, will, we believe, continue to deliver market-beating returns in the long term while constraining volatility. Whether coincidental or not, the other step change we've seen over the duration of the pandemic has been the embrace of sustainability as a cornerstone of investment strategies. ESG investing has emerged firmly and irreversibly into the mainstream. Companies, asset managers, and their advisors simply cannot afford to ignore the issues, both in their existing capital deployment and in the new opportunities created. The risks for companies that don't respond adequately to the impact of environmental and sustainability matters are growing, damaging their reputation, alienating their customers, and ultimately undermining their stock market valuation. Managing these risks requires an active approach, and my colleagues will introduce you to our own actively managed sustainable global equity fund, an established fund that has recently been approved for distribution to South African investors. So, summarizing, we're optimistic about prospects for equity markets, and we expect further gains in what we expect to be a broadly benign environment for the corporate sector. There are some significant headwinds currently, but we expect these to dissipate next year. And we believe that this cycle has much further to run. Following the sharp gains enjoyed since the turn in markets 18 months ago, it's likely that returns will be more subdued, but opportunities abound globally and across investment styles. It's important to stay invested, ride out any short-term volatility, and the best way to do so is by broad diversification globally and across investment styles, invested with some of the best fund managers from around the world. A package which my colleagues will now discuss in more detail.
morning, everyone, and thank you so much for your time. Joining me on the first panel discussion for today are two members of our investment team based in the United Kingdom. Andrew Hardy, our Director of Investment Management, and Robert White, one of our portfolio managers. Andrew and Robert are here as they are the co-portfolio managers for the Momentum Global Equity Fund, and are going to help me showcase why this core global equity solution is a valuable addition to your global investment toolkit. With a track record going back to 2009, the Momentum Global Equity Fund is our flagship equity fund that provides a well-diversified, style-balanced exposure to developed market equities and aims to deliver long-term capital growth in a highly liquid, cost-effective structure. Key to the success of this fund is its style-blended investment approach and the use of what we believe to be the very best investment managers from around the world. But just as the investment opportunity set available offshore is vast, so too is the number of global managers, and the adage of past performance is not necessarily indicative of future results couldn't be more true within the realm of asset management. So Rob, this leads me into my first question for today. Given the vast investment opportunity set offshore, what key characteristics do you look for when selecting managers to partner with?
Well, thank you, Natalie. And you touch on an important point there in the question, namely the vast size of the global investment universe. To get a rough idea of this, the number of regulated, open-ended funds on the market is over 125,000. And with such choice on offer, we can afford to be extremely picky when selecting managers. So we therefore only choose the very best of the best. Now, the first slide I have here highlights a few of the main characteristics we look for specifically. And I won't talk through all of the points now, but I'll cover a few select topics from here. And I think the key point to make right at the start is that we believe that no one fund management house has all the expertise. Instead, we think that specialist investment teams with well-defined areas of focus are the best way to allocate capital. We often find that managers that try to cover all bases at once sometimes lack any kind of identity. And I think a good way to visualize this is when you consider style specialized managers. From the work that we've done, we tend to find that value managers, they have a completely different thought process and toolkit to, say, growth managers. And when they apply their models based on concepts like mean reversion and normalized earning multiples, when they apply these to growth stocks, they don't always work very well. And it also goes the other way around. Growth managers can struggle to find attractive, cheap stocks. And for that reason, we will allocate separately to style specialized managers, typically holding several of each, say growth, value, and quality as well within a portfolio. A key attribute we look for is therefore consistency of approach. This is something that can be rare to find with managers, as styles tend to move in and out of favor, and the temptation for style drift can be strong. When we allocate to an active manager, we ensure they clearly follow one of our three defined style groupings, which are, as I mentioned, value, growth, and quality. We monitor consistency of style through various proprietary quantitative tools, and these enable us to customize and monitor how managers score relative to different style factors as we define them. If a manager is not behaving as we would expect, this gives us cause to question them and sets the agenda for what are hopefully productive discussions that we have in person. However, we don't just rely on a quantitative process alone. At the end of the day, this is a people business, and you need to understand the experience and motivations of the individuals involved in actually running the money. We have a rigorous process of assessing managers based on criteria such as risk management, capacity management, alignment of interests, focus, ESG, and much, much more. And we've been following this process for our more than 20-year history. With offices in London and Liverpool, we're also fortunate enough to meet in person with a huge range of managers on a regular basis. And this helps us build up an accurate picture of the overall market. And Natalie, in your question as well, you also mentioned the perils of overly anchoring to past performance. And since that is not always a reliable guide, it's not something that we do on its own. We don't just screen on historic data to find good investment ideas. And I think a good example that illustrates this is with our investment in Rainier's international equity strategy. And Rainier are a relatively unknown international growth manager, despite their impressive performance, as you can see here. The reason for this is that they only run US regulated funds, which are typically not accessible to investors who live outside of America. As a result, they often don't come up when international investors run screens. And then just going back through the history of our involvement with the company and our investment decision, we became aware of the team through our research initially into American Century investments. And that's where Henrik Strabo, then their CIO, was instrumental in developing a robust process, which we very much admired. And that was a process based on finding structural growth businesses going through an inflection point in their growth rate or some other change of their business fundamentals. So when Henrik eventually left to start a new strategy with Rainier, we therefore had the confidence to invest with him early, based on our knowledge and extensive research from his earlier career. And importantly, this was despite the fact that he had a relatively short track record at Rainier at the time. So I think our investment philosophy actually really helped us here, and when we could spot the manager early and invest and get the benefits from that. But the final thing I just wanted to mention is that we have a very flexible operational setup too. That's where we can invest with managers through segregated mandates rather than a typical fund of funds. This setup means we avoid a lot of the traditional problems that can be associated with fund of fund models, and gives us the freedom to allocate capital to the best managers in any jurisdiction across the globe, which in this instance with Rainier was truly invaluable.
Thank you, Rob. Now, Andrew, this one's I'm going to direct to you. Obviously, with an investment opportunity set of over 125,000 open-ended funds, an in-depth investment process is clearly integral to identifying those managers with some sort of competitive edge. What is interesting with the Momentum Global Fund structure is that it combines the benefit of human intellect, combining specialist fundamental active managers with the benefits of data science through a manager that employs a data-driven, systematic investment strategy. Andrew, why have you decided to structure the fund this way? And who are the managers you have decided to partner with?
Thanks, Nats. Yeah, within the portfolio, we combine systematic quantitative strategies alongside discretionary fundamental strategies, roughly in equal proportions. We think there are particular merits to each of those two broadly defined approaches, and that they're also complementary to each other. The systematic quantitative strategies are particularly consistent in terms of the style exposure they provide and give you a very pure factor exposure. Well diversified, lots of breadth through a large number of holdings, and through the rules-based nature helps to reduce the risk of behavioral biases creeping in and undermining returns. On the other side, discretionary strategies we think can provide additional outperformance over and above any particular kind of style or factor exposure through the managers having a particular competitive edge like Rob talked about, and ultimately being rewarded for taking on greater concentration risk. But that concentration risk requires deep due diligence, knowing the company really, really well, and is typically not suited for a purely quantitative approach. So we think the two complement each other well, and we combine them very carefully in such a way that we think we can maximize our chance of reaching our outperformance target for the portfolio, but also at the same time maintaining a high level of diversification and the ability to perform across a wide range of different market environments and regimes. We construct the portfolio in terms of strategy weightings in a very holistic sort of way, rather than looking at individual strategies and underlying strategies and setting those weights in isolation. Factors that would inform our weighting to discretionary or systematic strategies and the underlying managers within those would include things like the concentration of the strategy, the style in particular, the market cap distribution, the overlap with other strategies within the portfolio, geographical spread, and also our conviction in those managers as well. This chart shows you the map of our managers within our global equity fund, where each of the underlying managers are headquartered. And as you can see from this, we really are agnostic on location. we ourselves will travel far and wide to find the best talent rather than hoping that it's conveniently based around the corner from us here in the UK. You'll see here there's some familiar names that you'll recognise, but also some that are less familiar. We think that more focused operations, which would typically be the less familiar ones, often represent the best long-term performance potential, and conversely think that brand recognition does not equate necessarily to superior performance. Rob already talked you through the example of Rainier. Another one I'd highlight here would actually be Jennison, which is one of the larger firms within our roster here. They're part of the PGIM group, but still have very boutique-like characteristics within their own, the setup of their team and the alignment that they have within that business. Like with Rainier, we backed a very experienced team here. They joined in 2011 from Loomis Sales, where the lead manager, Mark Baraboo, was for over 20 years prior, building up a very good track record and honing his investment philosophy and process. So they were new to Jennison when we first invested in 2012, shortly after they joined. But we were willing to back them in an early stage because we'd done that deep due diligence and recognized the superior characteristics they had. We think they're particularly good at delivering outperformance within the growth and kind of momentum investment style, because in particular they're able to identify growth opportunities very early, and then also their fundamental analysis means that they have the willingness and ability to cut positions aggressively when the growth outlook for a particular stock changes. And that's very distinct, like touching on something that Rob alluded to. It's very distinct from the typical behavior of many other managers across different investment styles. And it's key when you're investing in their case, high growth, higher valuation stocks. Being willing to cut positions is key to the risk management of the strategy overall. We've been very well rewarded in this strategy. The manager who we've been invested with now for nearly 10 years has returned nearly 20% per annum net of fees. So an exceptional return and well in excess of what you'd get from a passive global equity index investment. And the final point I'd make is that pretty much all of these managers we access via segregated accounts. And that really does enable us to widen the universe and access a much wider pool of talent overall. But other benefits come from the segregated approach include full transparency on the underlying holdings, the ability for us to make the mandates bespoke to our particular needs, and it also helps to very much lower costs within the overall portfolio. And at the end of the day, we're not a fund of funds portfolio. The strategy is directly invested in equity strategies.
So on the active management front, as you would have seen on the slide, we've got Jennison, Rainier, and Granahan for our growth exposure, Contrarius and Hotchkiss and Wiley for our deep value exposure, Morgan Stanley, Artisan, and Paradise as our quality value exposure, and then finally, Rubico, providing multi-factor exposure through the value, quality, low risk, and momentum sleeves they manage. These 9 investment managers underpin the Momentum Global Equity Fund, obviously explains why this fund has exposure to over 800 companies, when some other popular active equity funds out there are much more concentrated in their holdings. Andrew, I'm going to direct this question at you again. Do you have any concerns regarding the level of stock diversification within the fund?
No, I don't. I think it's appropriate. Remember, this strategy is designed not to be one of many within a client's portfolio, but instead a core global equity portfolio that can reasonably represent the majority or even all of a client's international equity allocation, because we've got so much diversification built in. And you can see that on this slide here, which outlines how we diversify the strategy across those different approaches, discretionary versus systematic, and the different investment styles within that. But to answer the question in more detail, bear in mind that there's a global universe of about 10,000 or so securities based on the MSCI AC World Index. We're only selecting less than 10% of them and excluding some 90% or so. And within the portfolio, there is a reasonable amount of concentration still, particularly at the top end. So the top 100 positions in the portfolio contribute nearly half of the total portfolio overall. And a lot of that comes from larger cap businesses and those discretionary managers, whereas, as I said, it's more appropriate for them to take on concentration risk within there. And then the tail, the remaining 700 or so stocks, the majority of that comes from the systematic side of the portfolio, where the strategies there are targeting broad-based style factor exposure. And there, a lot of breadth and low concentration is actually better for maximizing risk-adjusted returns. The average active share of our discretionary managers is over 90%. So active share measures how much of your portfolio is different from the index. So they're all very high conviction portfolios and very differentiated from the index. Typically, the discretionary managers have about 30 to 40 holdings or so. And we think that's appropriate for these more style-specific, high conviction managers. But no one manager within there represents more than 15% of our portfolio. And then if you look across the overall portfolio, combining the systematic side of things as well, our overall active share is about 60%. So still very high, very differentiated from the index. And we think we've got the right balance in terms of the number of managers and the concentration of their portfolios. And wouldn't focus too much on just the number of stocks within the portfolio and thinking that's overly diversified. Instead, I mean, flipping the question on its head, with such a large global universe, as I mentioned before, how could one reasonably justify concentrating into only one or two funds that hold, say, 50 or so consensus and well-covered stocks when you've got such a rich universe to choose from?
Yeah, I mean, just jumping in there, Andrew, I think that's an interesting way of looking at it. Typically managers that have these highly concentrated portfolios might justify their approach through their historic performance, and the success of the FANG type stocks in recent years means that many growth investors who have concentrated in this way have performed well. But that you are taking implicit style biases and you're making an implicit kind of factor decision when you're concentrating in this way and just going via one approach. And investors have very long time horizons. Typically, if you're investing to retirement, you're invested in the market for decades. And looking back through history, different styles go through different periods of outperformance, and these growth names that have done very well over the last decade or so, actually, some of them really struggled in periods like the dot-com bust. So, if your entire global allocation is only 40 stocks, you can't really avoid taking on some of these big style and other idiosyncratic bets within your portfolio, and getting these wrong can be costly.
So clearly from our side, we provide investors with multi-layer diversification from a style perspective, from a strategy perspective in the form of data science and human active management, and then of course in the form of our asset managers that we use. But with so many equity funds out there, how should clients incorporate the diversified strategy offered by Momentum Global Equity Fund within their existing investment portfolios? And what benefit will the fund provide to the portfolio construct? Rob, I'm going to direct that one to you.
Thanks, Nat. So as Andrew earlier alluded to, we think the diversified nature of the fund means it's perfectly suited as a core global equity holding, giving you broad exposure to the asset class, with a single line item in your portfolio. Advisors can use the fund on a standalone basis, or as a complement to say, more concentrated managers who may take more specific risk, either in a, say, thematic growth style or in specific regions like in emerging markets, for example. We think it's important for advisors to be considering this sort of broadly diversified strategy now, really, given the unique macroeconomic backdrop in which we currently operate. So again, if you just spending a couple of minutes on this point, I think really you think we're coming out of an exceptionally low interest rate environment where growth assets have rallied hard and sit on historically high multiples. Most investor flows have unsurprisingly been into growth strategies and growth funds, and that means that the market has become highly concentrated in a handful of mega cap tech stocks. It still amazes me that the Facebook, Amazon, Apple, Google, and Microsoft now have a combined market cap of $9 trillion. And that's almost a fifth of the entire US market. So it indicates how this theme of concentration is really market wide. Whenever there's such large consensus in the market as we think we find today, we'd argue that it means there are higher risks of style rotations to come. And while we don't claim to be able to predict when such a rotation will take place, we do think it makes sense to diversify your risk on this front and not go blindly chasing performance. Over a full investment cycle, positive tilts towards all these factors, value, quality, and growth, do generate excess returns. And this is backed up by a wealth of academic research, but also in terms of realized performance. And that's shown from this next slide. So on this chart, you can see all of the lines here are above zero, which indicates that value, quality, and momentum styles have all outperformed MSCI World over this time period shown. However, the more striking observation for me is just how lumpy that outperformance has been. And that's not just for the value style, incidentally. It also applies to growth and quality too, as you can see here. The key thing I think to take away from this is that if you try and time styles and go for an overly concentrated solution, you do risk getting your timing wrong and underperforming over long time periods, as I've mentioned before. As investment managers, we at MGIM go to great pains to make sure that the mix between these styles is correct. And as a result, the fund is widely invested across different geographies, currencies, managers, as well as styles. And you truly get the benefit of going global rather than merely accessing a small handful of the largest well-known names. And as investment specialists, we believe in making these decisions ourselves rather than letting that risk sit with advisors who may not want to get involved in trying to blend different styles themselves. And as a final point, I know we've touched on elements of the structure throughout this conversation, but I think it's important to highlight them again here. So part of the reason to use this fund as part of your global equity allocation is that through the support of the wider momentum investments business, we can capture all of the attractive characteristics we've spoken about in this structure previously, and we can do it at a very competitive all-in cost, and that's at about 0.98% TER, just taking into account all costs. So our scale and the segregated account nature of the fund means we can get access to talented managers you won't currently have in your current portfolios. As I've mentioned, Rainier was a good example, but there's many others. And we can bring them together in a thoughtful, balanced and holistic way to deliver our performance. So I've just got one final slide here, and all of these arguments that we've spoken about are summarized succinctly here. And I think it just highlights some of the key takeaways to take with you. But I can just say we are genuinely very excited to be bringing this solution to the South African market right now. We think it's the perfect time to be bringing this sort of solution to market, and we think we really do offer something unique that can help add value to most client portfolios.
Thank you, Rob and Andrew, for providing a better deep dive into the fund. We all know the investment opportunity that awaits offshore, and through providing access to specialist global investment managers in a style-balanced approach, the Momentum Global Equity Fund has made investing offshore and investing in offshore equity managers that much simpler for you and your clients. Hello again, everyone. For the next panel discussion, we move from the active equity strategy of the Momentum Global Equity Fund to our data-driven, rules-based investment strategy in the form of the Momentum Global Sustainable Equity Fund. Andrew Hardy is here again for this session, as he is also a co-portfolio manager on this fund, alongside one of our senior analysts in the UK, Lorenzo Laposta. Big picture, the Momentum Global Sustainable Equity Fund is a well-diversified, low-cost equity strategy, providing investors with exposure to global developed markets. As an enhanced index strategy, we are excited to be bringing this fund to our South African investors because of its unique characteristics. It combines the benefits of both active and passive management. It exhibits multi-factor characteristics such as quality, momentum, value, and size. And as the name suggests, The fund also integrates sustainable factors in the portfolio construction process. So to lead into the discussion today, Lorenzo, can you please explain what an enhanced index fund is and how the portfolio construction process within the Momentum Global Sustainable Equity Fund works to incorporate all the benefits I mentioned earlier?
Sure, Natalie. An enhanced index approach consists in a data-driven strategy that takes what's good of a benchmark and improves on it by taking small deviations, all done in a properly risk-controlled way. The fund takes as a starting point, in this case, a global equity benchmark, and it's as diversified as that at a country, sector, or even stock level. So not differently from what you get with the passive exposure, the main risk here is that of carrying global equities within your allocation. But our strategy then tilts away from benchmark weights by taking high exposure to stocks with attractive fundamental characteristics. I'm thinking about better valuation metrics, stocks trading at discount to fundamentals, or for instance, those with stronger growth, higher momentum, better quality, or more solid balance sheet, and even a smaller size. All of these tilts should help improve the longer-term return perspective and ultimately help outperform the benchmark over the long run. On top of those more fundamental factors, this strategy also incorporates ESG factors, so environmental, social, and governance. This helps reduce the portfolio's environmental footprint, measured by the water usage, the waste generation, the greenhouse gas emissions of it. That would increase the portfolio sustainability and ultimately bring benefits to both investors in the form of better risk-adjusted returns, but also surrounding societies and the environment in general. The strategy is rebalanced monthly, such that at each point in time there is a very efficient risk-taking and very measured deviations from the underlying benchmark.
Thank you, Lorenzo. Now that leads me nicely into the topic of environmental, social, and governance factors, so ESG. Sustainability is high on everyone's agenda, from asset managers like us, to governments, to businesses, and now to investors who also want to make a positive impact. But as assets continue to flood into this area, there are concerns that some investment providers trying to capitalize on the growing demand for environmentally sound products could potentially be conveying a false impression of their actual ESG integration. How do investors navigate potential greenwashing when it comes to selecting sustainably orientated products? Andrew, I'll direct this question to you.
I think the new regulation is going a long way towards reducing greenwashing risk for investors. Europe's at the forefront of that with the recently introduced Sustainable Finance Disclosure Regulation, or SFDR. The taxonomy behind that is shown on this slide here. Essentially, it's created three different types of funds: Article 6, Article 8, and Article 9. Only Article 8 and 9 funds are allowed to promote themselves along ESG lines and the specific ESG characteristics that their strategies have. Our sustainable equity fund, being Luxembourg domiciled, is captured by this regulation, and we have got Article 8 status, having demonstrated deep and systematic integration of ESG and related risk considerations in our investment process, which is hard-coded into the prospectus as well, and along with commitments to provide appropriate disclosures and reporting to investors as well. I think other jurisdictions will inevitably follow similar sorts of regulation in time to further reduce greenwashing risk and to create a level playing field for asset managers and their investors. Bear in mind, though, there's a lot of variation across all these different types of funds still. So even within Article 8 funds, the way in which you execute ESG integration and the particular characteristics of your investment style and process inevitably vary significantly. So further deep analysis of the particular strategy is still required there. Also, I think it's really important, just lastly, to say that you interrogate the manager on their approach as well. Do they walk the walk? I think we do a fantastic job on that front as a business in three ways in particular I'd highlight. So we've been UNPRI signatories, that's the United Nations Principles for Responsible Investment, since the very early days there, signing up for that in 2006 and supporting it ever since, and making sure that we live up to those principles across our business. We have very good governance practices as well. So we have a responsible investment committee here, which oversees the ESG integration into the investment process and meets quarterly to make sure that we're consistently progressing our ESG best practice. And then also recently we published our first UK Stewardship Report as well, which is a large document, but it provides very detailed reporting on our stewardship practices across all of our portfolios, and some really useful, tangible examples of how good ESG practice lives in all of our portfolios beyond just this fund that we're talking about here.
Thank you, Andrew. So I suppose you already alluded to it earlier. The Momentum Global Sustainable Equity Fund has been classified as an Article 8 fund. So how are ESG factors incorporated within the portfolio construct, and how does its sustainability credentials compare to its benchmark, the MSCI World Index?
Okay, so there are three key and distinct areas of ESG integration within the portfolio. The first is exclusions of controversial areas, shown here on this slide, including areas like coal, tobacco, and controversial weapons, where we make no investments in those areas. We don't want to lean too heavily on exclusions, though, because it can narrow your universe more than is desirable, and also recognizing that blanket excluding businesses limits your potential to reward those that are changing their spots, that can actually be part of the solution. The second element is ESG score enhancement, where we aim for a 20% improvement relative to the overall index. And the third is a 20% reduction in the environmental footprint of the portfolio based on a look through to the underlying businesses. This next slide shows the footprint intensity side of things in more detail, and what we are actually achieving at the moment based on latest available data on the estimated environmental footprint of the portfolio measured relative to the global equity index. So three key underlying areas to the footprint that we look at: water usage, greenhouse gas emissions, and waste generation. So all of these are at least 20% reduced compared to the MSCI World Index. So putting that into a real world context, based on an investment of $1 million into the fund, it's estimated that the CO2 equivalent emissions of the underlying portfolio will be some 12 tons lower than an equivalent investment in a passive index tracker. So a very tangible improvement on a key ESG metric there. And finally, I'll just mention that this is a bespoke portfolio construction and controlled via a specific investment management agreement with the underlying manager. And to be clear, this is built into the investment guidelines of our fund prospectus as well, these objectives, which is a key step in getting Article 8 approval in the first place, because the requirements of the regulators now are very demanding to reinforce SFDR and help deliver on that goal of creating a level playing field and minimizing the greenwashing type risks you alluded to, and eliminating loosely defined targets or commitments.
Thank you, Andrew. That slide on the fund's footprint intensity clearly highlights that the investment process and security exclusions employed by the fund is clearly working to enhance the fund's environmental footprint. But does investing according to ESG principles mean that we will sacrifice returns for our clients invested in the Momentum Global Sustainable Equity Fund?
No, I don't think so. First and foremost, I think of integrating ESG into a portfolio as helping to reduce downside risk over the long term, because businesses with large negative externalities are increasingly coming under the microscope. And if you're doing wrong by other stakeholders, then shareholders will eventually suffer too. If you've any doubt about that, just look at all the commitments that came out of the recent COP26 summit here in the UK. And there's a lot of research and academic studies that provide a wide range of well-researched answers to that question of how does ESG integration impact on portfolio returns. And there was a recent kind of study of studies that found it probably does enhance returns to a degree, which stands to reason, I think, given the risk reduction point that I made. But it's hard to isolate from other factors as well. For example, ESG portfolios typically have less exposure to fossil fuels and the energy sector overall. So when there's a period of falling energy and commodity prices like we saw last year, then that's all else equal going to contribute to the outperformance of ESG strategies. But we shouldn't necessarily see that as outperformance of the ESG factor per se, but rather an effect of the natural industry bias that often arises in portfolios like this. There'll always be a wide variation across different strategies because they're all constructed differently across any given Article 8 fund, for example, or global equity ESG integrated strategy. And I think the average performance of ESG strategies will be time varying. Within this particular portfolio, we split the risk budget across, in terms of tracking error, across ESG factors. Taking deviations from the index in order to achieve those ESG objectives that I mentioned. But then also using some of the tracking error to target traditional risk premia, so value, momentum, quality, and the like, which have been shown to drive outperformance over the long term. From that side as well, we think you can get alpha generation. And therefore, the short answer would be no, I don't think you need to give up on return potential.
Thank you, Andrew. Now, as multi-managers at Engine, core to what we do is look for the best of breed global managers. And you heard from Robert White earlier on the characteristics we look for when identifying asset managers with a competitive edge. Rubico is our manager of choice for the Momentum Global Sustainable Equity Fund. Could you explain why Rubico stood out of the crowd against other quantitative managers? Lorenzo, I'll direct that slide to you.
Natalie, we met many managers as a start, and we thought Rubico was the best position in that sweet spot between quantitative strategies and sustainable investments. On the former, they're absolute pioneers. They have more than 25 years history in quant strategies, and today they have more than 40 investment professionals that run more than 80 billion euros based on quant models and factor strategies. On the sustainability side of things, they also had a very good pedigree. Currently, more than 90% of their assets under management is actually managed in ESG integrated strategies or impact strategies. So, to get back to Andrew's point, Article 8 or Article 9 funds under SFDR, and their very first sustainable product was actually launched in 1995. So that's 26 years ago. We like them because of those reasons, but we also actually highly appreciated how actively involved they are in academic research in both areas. We could leverage their expertise, and as Andrew mentioned, we sat down with them to customize our strategies, and in particular, to choose how much risk budget to give to multi-factor models, to ESG factors, which sectors to exclude as well.
Clearly a notable partner and custodian to assist us in managing our clients' assets. Now, we have covered quite a lot of points on this fund, so I think the final question that is important to cover is that of passive investments. Just as there has been a flood of assets into sustainably integrated investment products, so too have we seen assets flow into passive solutions, given that they provide access to various market exposures and, of course, are a means to bring down portfolio costs. But in the same way cost does not equal value, passive alone does not solve for all investment outcomes. So Lorenzo, explain why we believe investors should consider using the enhanced index strategy of the Momentum Global Sustainable Equity Fund as an alternative to a passive solution.
Well, we think with our fund, you can get the best of both worlds. This Global Sustainable Equity Fund is as cheap as a passive fund and gives you pretty much the same levels of diversification, of broad market exposure. So it's very efficient from that perspective. But on top of that, it also integrates ESG factors as well as style premia. So by investing in this product, you want not only have exposure to global equities, but you also have a better sustainability profile. You'll have a lower environmental footprint. And over the long run, over a full business cycle, we think you'll have a higher chance of outperforming the benchmark thanks to the broad exposure to the value, momentum, quality, and size premium. And all of these is constructed and implemented in a very sophisticated way with proprietary factor definitions as well as the academic validated ones. It incorporates advanced trading models, customized parameters, and also a lot of technology and expertise behind it. So you pay passive-like price, but you get a lot more. And as some of you would know, we're strong advocates of active management. And this product is effectively a data-driven active fund that keeps all the good things about passive investments, but enhances its return potentials and fundamental characteristics.
Thank you, Lorenzo. With an annual management fee of 0.3% per annum and an estimated total expense ratio of 0.55% per annum, our Momentum Global Sustainable Equity Fund is clearly a compelling solution for your cost-sensitive investors. And thanks to the multi-factor and ESG characteristics embedded in the fund's portfolio construction process, investors should be rewarded over time through outperformance of the benchmark. So with that, we come to the end of the panel discussions today. We hope these sessions provided greater insights into our two global equity solutions and that you can see why the Momentum Global Equity Fund and the Momentum Global Sustainable Equity Fund will enhance your clients' existing offshore investment portfolios. You have seen our excitement in finally bringing these two solutions to South African shores, and hopefully you can now understand why.
Today, we have covered all things related to investing offshore, from our economic outlook to our active and enhanced index global equity solutions that have recently been approved by the FSCA, and of course, Momentum Global Investment Management, our international investment division within Momentum Investments. Hopefully, you would have gathered from Ferdy's section that MGIM is all about partnerships. And for us at Momentum, a partnership with you means trying to assist your clients in achieving their international investment goals. With that, we are passionate about continuously enhancing our global offering to South African investors. Through bolstering our existing US dollar denominated multi-asset offering with these two global equity funds, we truly believe we are adding additional tools to your global investment toolkit. This is because not only does the Momentum Global Equity Fund and Momentum Global Sustainable Equity Fund give South African investors access to best-of-class third-party equity investment managers from around the world, such as Rubico, Hotchkiss & Wiley, as well as Rainier. But you can also be confident that these solutions continue to be relevant and future fit in an ever-changing investment landscape. Be it high-conviction active strategies or data-driven systematic strategies, multi-factor risk premia, or environmental, social, and governance factors, these two global equity funds together will provide investors with the best of all worlds. And what is more, the funds are available at attractive costs, largely due to the segregated nature in which we have access to our underlying investment partners, as shown on the slide. From an accessibility perspective, the funds are already available via Momentum Investments' offshore platform, Momentum Wealth International. To broaden distribution, these funds are also in the process of being loaded onto the Glacier International platform, and hopefully additions onto further offshore platforms will come down the line shortly too. Alternatively, should you wish to access these funds through your local investment portfolios, whether it will be via a monthly debit order or lump sum investment, both these funds will also soon be available through cost-effective rand-denominated feeder funds. So, watch the space. And I think the final points to highlight is that although we are only launching the two global equity funds to South African investors now, both strategies, importantly, have a long track record, not only in terms of their performances, but also in terms of the consistency in the MGIM investment team, managing them and the implementation of the strategies throughout their histories. Remember that timing the entry point for investing is always fraught with difficulty, and very few investors can demonstrate consistent success in doing so. As quoted by Ken Fisher, an American billionaire investment analyst and author, timing the market always beats timing the market. And this will never be more relevant than when you consider offshore investments for your clients. So what are you waiting for? Consider including the well-diversified Momentum Global Equity and Momentum Global Sustainable Equity Fund within your clients' investment portfolios, so that from today, we can help your clients achieve their international investment goals.